Today, we're diving deep into a fascinating area of accounting. IAS 40, Investment Property. First things first, what exactly is an investment property? According to IAS 40, it's property land, or a building, or part of a building, or both held to earn rentals or for capital appreciation, or both. The key here is the asterisk purpose asterisk for holding the property. It's not for use in the production or supply of goods or services, nor is it for administrative purposes, and it's definitely not for sale in the ordinary course of business. Think of a company that owns an office building and rents it out to other businesses. That building is a classic example of an investment property. Now, let's contrast this with other types of property. For instance, a factory building that a company uses to manufacture its products would be classified under IAS 16, Property, Plant, and Equipment. This is what we call an owner-occupied property. Similarly, if a real estate developer builds apartments with the intention of selling them, that's considered inventory under IAS 2. The distinction is crucial because the accounting treatment is completely different. So remember, the purpose is everything. Is it held for rental income or long-term value growth? If yes, you're likely looking at an investment property. Let's talk about the initial recognition. When do you first record an investment property on your balance sheet? The rule is simple. You recognize it as an asset when two conditions are met. First, it's probable that the future economic benefits associated with the property will flow to the entity. This usually means you expect to receive rent or sell it for a profit. Second, the cost of the property can be measured reliably. This is straightforward. It's the purchase price plus any directly attributable costs, like legal fees, property transfer taxes, and other transaction costs. Pretty logical so far, right? Okay, so you've bought an investment property and recognized it on your books. What happens next? This is where IAS 40 gets really interesting. It offers a choice for subsequent measurement, the cost model or the fair value model. And this choice has a huge impact on the financial statements. Let's start with the cost model. If a company chooses this model, the accounting is very similar to IAS 16. The property is carried at its cost, less any accumulated depreciation and any accumulated impairment losses. You depreciate the building over its useful life, just like you would with an owner-occupied property. This is the more traditional, conservative approach. It's stable and predictable. But now for the exciting part, the fair value model. Under this model, the investment property is remeasured to its fair value at the end of each reporting period. Fair value is the price that would be received to sell an asset in an orderly transaction between market participants. Any gain or loss arising from this change in fair value is recognized directly in the profit or loss for the period. Let's pause on that for a second. This is a major difference. Under the cost model, value changes are only recognized through depreciation or impairment. But under the fair value model, both increases and decreases in the market value of the property hit your income statement every single year. This means your profits can be much more volatile, swinging up and down with the real estate market. Also, a key point to remember: once you choose the fair value model for an investment property, you don't depreciate it. Why? Because the fair value already reflects the current condition and economic potential of the property, making depreciation redundant. So, which model should a company choose? IAS 40 states that an entity should apply its chosen policy consistently to all of its investment properties. However, there's a small exception. If you acquire an investment property and you unreliably determine its fair value on an ongoing basis, you must use the cost model for that specific property. But this is considered rare. For most properties in active markets, determining fair value is possible. Now, what happens if the use of a property changes? This is a common scenario. A company might decide to start using a building it was previously renting out for its own administrative offices. In this case, the property is no longer an investment property. It becomes an owner-occupied property. This requires a transfer. If you're transferring asterisk from asterisk investment property carried at fair value to owner-occupied property, the fair value at the date of the change becomes the deemed cost for future accounting under IAS 16. Any subsequent depreciation will be based on this fair value. What about the other way around? Let's say a company vacates its own building and decides to lease it out. It's transferring from owner-occupied property asterisk to asterisk investment property, if the company will use the fair value model. Any difference between the carrying amount of the property and its fair value at the date of transfer is treated as a revaluation under IAS 16. This means an increase goes to a revaluation surplus in equity, not directly to profit or loss. This is a critical detail that often trips people up. The gain only hits the income statement later, when the property is eventually sold. Let's talk about derecognition. When do you take an investment property off your books? You derecognize it on disposal when you sell it or when the investment property is permanently withdrawn from use and no future economic benefits are expected from its disposal. Any gain or loss on the disposal is calculated as the difference between the net disposal proceeds and the carrying amount of the asset. This gain or loss is recognized in the profit or loss for the period. Finally, let's touch on the disclosures. Transparency is key. Companies using IAS 40 must provide detailed information in their financial statements. This includes disclosing which model they use, cost or fair value. If they use the fair value model, they need to explain how they determined the fair value. For example, if they used an independent professional valuer. They also have to present a reconciliation showing the movement in the carrying amount of investment property from the beginning to the end of the period. This shows additions, disposals, fair value gains or losses, and transfers. These disclosures give investors a clear picture of the company's real estate investment strategy and performance. So, to recap, IAS 40 governs properties held for rental or capital appreciation. The initial measurement is always at cost. For subsequent measurement, you have a choice between the cost model cost less accumulated depreciation and the fair value model remeasured to fair value each period with changes in profit or loss. Transfers between property types have specific rules, especially regarding how value changes are recognized. And finally, comprehensive disclosures are required to ensure transparency for users of the financial statements. It shows how accounting rules directly reflect the business purpose of an asset and can significantly impact a company's reported profits and financial position. Thanks for watching, and I'll see you in the next video.